In just 1 month, the most powerful financial institution on earth, the United States Treasury, tried to save the market twice, and both times, the market laughed in their face. Right now, to the U.S. national debt has officially smashed through the $40 trillion ceiling. To put that in perspective, we are adding $1 trillion to the debt roughly every 6 months. The math is completely broken. But here is the scariest part, the part that mainstream financial media is quietly ignoring. The authorities are finally trying to hit the brakes, but the brake pads are entirely gone. Today, we are going to look at the exact moment the market stopped believing the U.S. government. We're going to break down the terrifying death spiral that is currently consuming the bond market, why smart money is using the government's rescue attempts as a chance to run for the exits, and most importantly, how this $40 trillion avalanche is about to hit your mortgage, your retirement, and the global economy. Grab a drink. This isn't just a market cycle. This is the end of an era. To understand how bad it is, we have to look at the 2 rescue missions that completely backfired. Let's rewind to late July and early August. The Japanese yen was plunging to 4-0-year lows. The U.S. Treasury did something they haven't done in nearly 3 decades. They stepped in directly, alongside Japan, to intervene. For a second, it looked like a victory. The yen bounced. But if you've been in markets long enough, you know the fatal flaw of intervention. You can manipulate the price for a day, but you cannot manipulate the fundamentals. The massive interest rate gap between the U.S. and Japan was still there. So, what did the smart money do? They didn't get scared. They saw the government's intervention as a gift. They used the artificially high price to double down on their short positions. The government essentially became free exit liquidity for the big players. Then came August 19th, the day the dam broke. The Treasury announced they were doubling their buybacks of long-term government bonds. This was supposed to calm everyone down. But on that exact same day, the national debt crossed $40 trillion. The Treasury went to auction off 2 0-year bonds, fully expecting their announcement to keep interest rates low. Instead, the market essentially spit in their eye. Yields shot up above 5.2%. The next day, 3-0-year yields surged right back over 5%. Why? Because the market can do basic math. The Treasury is throwing a few $1 billion at a $32 trillion market. It's like trying to put out a forest fire with a squirt gun. It's purely theatrical. And Wall Street knows it. So where is all this money going? Why is the hole getting deeper? It's a perfect storm of bleeding revenue and exploding costs. Tax cuts are draining income. Meanwhile, we're funding a proxy war in the Middle East, pushing oil past $90 a barrel, and reigniting the inflation fire. But the real killer, the silent assassin in this story, it's the interest. This fiscal year, the U.S. government is spending over $1 trillion just to pay the interest on its debt. Read that again. We are now spending more on interest than we do on the entire U.S. military. It's the second largest line item in the budget, right behind Social Security. This triggers what economists quietly refer to in private as the death spiral. Here's the psychology of it. Yields go up, which means it costs the government more to borrow money. Because it costs more, the deficit gets bigger. Because the deficit gets bigger, they have to issue more bonds. Because there are more bonds flooding the market, investors demand higher yields to buy them. Rinse and repeat. Just in the month of July, the U.S. ran a deficit of over $430 billion. That's a record. This spiral isn't a theory anymore. We are living inside it. What we are witnessing is the yenification of the U.S. Treasury market. Whenever the Treasury announces a rescue, bondholders use that bounce to sell. You pump the price, I dump my bags. This is no longer a financial mechanical issue. It is a profound psychological collapse in trust. Everyone sees the end game. They know the debt is only going one direction. So, if the ship is sinking, the only logical move is to grab a lifeboat while the band is still playing. And this storm isn't just contained to Wall Street. In mid-August, we saw a synchronized global sell-off. Japanese 1-0-year yields hit highs we haven't seen since 1996. French borrowing costs spiked to 2008 crisis levels. British yields jumped back to the 90s. This isn't a glitch. This is the entire developed world's debt model being questioned all at once. Since 2021, we've had the European energy crisis, wars, regional bank collapses like Silicon Valley Bank, and inflation shocks. Every single time, the solution was the same. Print more money, bail out the system, and push the problem into the future. But you can only kick the can down the road until you run out of road. And who pays for this? You do. If this borrowing pace continues, research shows that retirees will implicitly lose hundreds of dollars a month to inflation and currency devaluation. If you are a family trying to buy a house, you are going to pay tens of thousands of dollars more in interest over a 30-year mortgage. The government's debt is just deferred taxation on the middle class. To you, Treasury bond is the ultimate anchor of the global financial system. Central bank reserves, pension funds, global trade, it all rests on the assumption that U.S. debt is the safest asset on earth. When the anchor cracks, every single asset tied to it has to be violently repriced. Historically, when an empire builds up this much debt, there are only a few ways out: tax your citizens into oblivion, cut spending and military presence, explicitly default, or inflate the debt away and steal the purchasing power from the public. Bank of America expects the debt to hit $50 trillion by 2029. $40 trillion isn't the finale, it's just a mile marker on a very steep hill. The market has sent its message. The patience is gone. We are entering a period where the global economy is going to look a lot like a dark forest. The players who survive won't be the ones holding pieces of paper backed by a struggling printer. The survivors will be the ones who hold real assets, who build self-sustaining economies, and who stop relying on a single, dying monetary anchor. Are you prepared for the repricing of the world? Let me know in the comments below what your safe haven is.